In this lecture, we're going to talk about human capital. And basically, human capital is a measure. We talk about physical capital. Human capital is a measure of knowledge, productivity. It's the human aspect. Okay, so the more human capital you have, the more you invest in yourself, the more you know, the better worker you can be. So many labor supply decisions require substantial initial investment by the worker. Okay, so you need to do a lot up front in order to get the payoff down the road. School is an example of this, college. You pay a lot of money for school early to get the benefit later. So what happens is that the decision is going to depend on lifetime earnings and not just current. So current earnings is what you currently make. So you might think to yourself, all right, well, why should I go to college and spend $30,000 if I can work and make $30,000? Well, I would hope that you understand that the point of that, why you do that, is to make more money later on to compensate for it. But that's where you need to look at lifetime earnings instead of just current earnings. So there's three basic types of labor market investments, right, where you try to increase your human capital. The first is education and training. That's the basic one. That's the one that most people think of. You go to school, or you get on-the-job training, or you take training courses. All this is making an investment. You're spending money now to make money later. But another example is migration. So you're spending money to move to an area for better work. Why would you do that? Why are you spending money to go somewhere for a job? Because you think the benefits of doing that are going to outweigh the cost of doing it. And finally, the search for new jobs. It takes time and money to search for a new job. And so when that happens, okay, that's another investment that you are making. Now, these investments take place over 3 time periods. The first is early childhood. So early on, you make decisions. A lot of decisions are made by others. So your parents make the decisions for you for as far as grade school, high school. But as you get older, however, okay, during your early teen and young adult years, that's when you start to take and make those decisions. And so the teen and young adult years is going to be your decision of where to go to school, what type of school, what you want to study. And then finally, the final stage is when you actually enter the labor market. You need to then decide what types of training you want to make or how you want to do your job search. So the human capital investment model, the main part of it, starting point, is that all investment requires some sort of cost. Maybe monetary, maybe non-monetary. Remember, we're talking about economics terms. They all require cost. So there's 3 types of costs. There's that out-of-pocket or the direct expenses, that money that you have to take and then give. But because we're talking in economics, we also have those foregone earnings, the money that you could have been making had you not taken the training or schooling, plus the psychological losses. Right? It's stressful. It's grueling going through this schooling and training. And this is another cost you need to consider. Now, people tend to bear these costs because of the returns that they expect to get. The benefits outweigh them. Now, when making an investment decision, you need to think of present value versus current value. So, for example, the question would be, what's worth more, $100 today or $100 next year? Well, you would know that with inflation, because prices go up, you can buy more of that $100 today than a year from now. And so it's worth more today than later. And so with this, when you're trying to make these decisions, you need to determine if the benefits are greater than the costs. But because a lot of those benefits are going to be realized down the road, you need to figure out how much they're worth today. And so if you spent $100 for a training today, and you expected 10 years from now to get $110 for it, is it worth it? Probably not, because $100, $110 10 years from now is going to be worth less than $100 is today. So the current value is the value at any given year. The current value is $110 10 years from now. The present value, it looks at everything in today's dollars. It's adjusting for the interest you could have earned, inflation, stuff like that. So the present value is comparing apples to apples. It's looking at the costs and the benefits in just today's dollar. So the investment decision, what decision should you make? You should make the decision where you're going to maximize your net benefits. And not just your net benefits, the net present value of your benefits. Because again, you want to compare apples to apples. And so if we look at the marginal benefits and the marginal costs of, this is for different units of human capital, but you can think of it as years of schooling. So the more schooling you get, okay, you're going to get benefits from it. So you're going to get more benefits. Your benefits are going to be higher if you get a high school diploma, and they're going to be higher if you get an associate's degree, higher if you get a bachelor's degree, so on and so forth. Okay. But those benefits may fan out a little bit. So what you're going to have is the marginal benefits of that. And the marginal costs, just assume that each credit hour you may take is the same. Your decision will come down to comparing the benefits and the costs. And when you look at marginal benefit and marginal costs, you know that when that happens, where you're going to maximize your net benefits is going to be where the two equal each other. So where the additional benefit is going to equal the additional cost. And so in this case, it's HC star. But let's say it becomes, that can change, however. Let's say that things happen that change the costs or the benefits. So for example, let's say that each credit hour going to school becomes more expensive while the benefits stay the same. Well, you see that with an upward shift in the marginal cost curve. Okay? And when that happens, you're going to take less, there's going to be a lower equilibrium of human capital. You're going to take less training, less schooling because of that higher cost. On the other side, if you look at the benefits, let's say the benefits go down. Let's say the returns from schooling decrease. And again, in that case, you would see a decrease in the human capital, decrease in the schooling you would take. So let's look at the demand for college. So this looks at, you decide whether they're going to have to go to college. So why do people go to college? Well, let's look at an example here. So we have foregone earnings, tuition, and books. These are going to be your costs of going to college. So by going to college, you could have made this money here. Okay, so by going to college, you're giving that up. And in addition to that, you're also paying tuition and books. So not only are you not making money, you're giving money to the school. Well, what's going to happen is that if you didn't go to school, yes, you'd be missing this wage, but those without a college degree, and we'll show this a little more later, don't see that rapid of a rise in their pay. Whereas those who get a college degree see a more rapid rise. So the benefits you're going to get are going to be that higher wage, the higher earnings you will get from going to college. And so it'll be the difference between your earnings with college and earnings without. So these are your benefits, these are your costs. The reason why people go to schooling is that the general belief is that the benefits of going are greater than those costs. So now that's schooling decision. There are other factors that go into it. So for example, people being present-oriented versus future-oriented. So people who are more concerned with today, more concerned with enjoying life today, are not going to be as patient and are not going to want to wait for those benefits down the line. They're not going to wait till over in here when they would make up that amount. Whereas people who are more future-oriented are going to be more likely to go, because they're willing to wait for it. They're willing to give up more now to make more later. Age is a big factor. Younger people have higher total benefits. If you're younger and go to school, you have more years to collect on these benefits up here. Where if you're older, you're going to have less years. And so because of that, younger people have more incentive to go to school. Costs. The higher the costs, the more benefit needs to make up that gap. And the earnings differentials. The wider the gap, the wider this gap becomes, the more incentive there is to go to school. Whereas the smaller it becomes, the less incentive there is. And so this shows changes in college enrollments and high school or college high school earnings, but differences by gender. And so you can see the ratio of mean earnings of college to high school graduates. Okay. So this shows that for males in 1970, college graduates made within that age group 38% more, whereas females made 42% more. And you can see that for the most part it's gone up, although it dipped in 2010 because of the recession. But there's been a general trend. So this is showing that the benefits from college are going up and up. And at the same time, the enrollment rates, for the most part, have been going up. And so what you're seeing is you're seeing more people going to college and, or because of, depends on which came first, the chicken or the egg, the benefits from college are becoming greater and greater.